something we talk a lot about in financial advice is goals. It's goal setting, it's goal tracking, it's goal management, goal achievement. And what that translates to, I think, really well in the divorce area is helping people translate some of the more generalized concerns or worries or aims they might have into goals that let us then calculate the numbers around it. The reason I think that's important when it comes through to divorce is that having those discussions and having those landmarks to grab onto during the process can actually alleviate quite a lot of the stress involved, because you know specifically and exactly what it is that you're looking for and pursuing through the negotiation process. And that can provide you clarity. It also lets you lift your eyes from that more immediate series of concerns you have in the day-to-day to and fro of a divorce, to look beyond that into the future that you're building for yourself and that you're chasing and pursuing for yourself. So I find that very important. It's challenging. It's a tough thing to work through. And we've found that we've had a few people come through to us just to have that conversation. So not financial advice specifically. We're not exploring, their existing asset pool or the financial ramifications of certain decisions yet. It is simply about taking what they have at the back of their mind and what they're worried about and what they're scared of and what they're concerned about, and turning that into some hard numbers for them to then rely upon as they work through the process. So I'll explain a little bit about what I mean. So the first one is when we see people, and often when they're already confronting the divorce reality or they're dealing with their other advisors, it's translating those concerns into words, and into words that then become actionable, to use a horrible word. So often when we see people, it's things like this. It's, I need enough to live afterwards. I don't really know how I'm going to pay the mortgage. I'm worried about paying the mortgage. I don't want to get stuck with a big mortgage. I will not have the earnings or the income that the other party will have, so I don't really want to be stuck with a mortgage. A completely understandable and common and critical consideration is, I don't want the kids to be disrupted too much. I want them to still be able to go to their extracurricular activities. I still want them to be able to go to the schools that they're in. I want to be able to provide them some stability through this inherently disruptive process. And also, just I can't stay in this house. Now, be that because the house is too big now, there's too much upkeep involved, it's just not a place filled with happy memories, or it's not in the area that you want to live in. So we had somebody recently, they are living in regional Victoria, and post the divorce, they're very keen on moving back to Melbourne. Their family was in Melbourne, so that's the avenue they wanted to go down. So these are common sentiments, common phrases, common positions to have, but in terms of what we do, which is quantifying that into numbers, we can't do a lot with that. So our first part of our process is exploring what this actually means in their own words and in their own reality. So during that process, it's normally an hour or two, and we just have a conversation. We explore what all of this actually means, and we work out some of the numbers that are involved. So dealing with somebody or helping somebody, make sure they have enough to live on. What is enough? What does enough actually look like to them? Is it maintaining their current lifestyle? Is it adjusting to a new lifestyle? Is it making sure that maybe their lifestyle improves a little bit? It's that whole spectrum of areas. So in this particular case, the example we're talking through today, we worked out that $60,000 a year pre-tax would be enough for them to maintain their lifestyle. And they did not want to change that, and that was really their baseline. One of the questions we had to work through, and when we come to the alternatives, it's how many years will that income last for? How many years do they need that income coming in? And what is their plan to assume as much of that responsibility for that income as they can over those years? The second one was really, really strongly, I don't want a mortgage. I don't intend on working while the kids are in school. I want to be home when the kids come home, and I can't afford to maintain a mortgage, so I'd rather not have one. So that was a really strong priority in that case. We worked out the kids' activities. It was sports. There was some dancing involved. There was another activity that was costing money. There was some travel involved. I can't quite remember what it was. But they really wanted to make sure they were able to maintain that. And from what they said, it sounded as if their soon-to-be ex was of the same mind. So we worked out that costs about $10,000 a year for both kids. The kids will be finished school, but they'll both be finished within the next 6 years. So that's the timeline we're looking at there. And finally, this person, they were living in regional Victoria. They wanted to move back to Melbourne, and they were budgeting. Essentially, they said, I want to live between 20 to 30 minutes from Melbourne. I don't want to rent. I want to own the house. And the budget that I'd be comfortable spending, knowing the Melbourne market, is somewhere between 1.2 to 1.5, because that was the price that they were seeing a lot of the prices around their family go for, a lot of the houses for their family go for. That being said, they needed a house with 3 bedrooms for when they had the kids, and they also needed they preferred a house. They wanted the space around them, but they were willing to look at an apartment or a unit if need be. We took that and we've run our calculations. So this here summarizes the numbers that we put together for our client. And our goal here is to give them 3 different tiers, which gives them 3 different numbers, so they know that at a certain level, if they can achieve this amount of money through their property settlement, it'll pay for this standard of achievement or this standard of living in their goals. So this is if they were to get everything they wanted, which most people going through a negotiation know is very much a long shot, but we like to set it at the top tier so they know what they're looking at. So in this case, $60,000 a year, capitalised with 5% a year over the next 20 years. This person was 45, was $785,000. An interesting note here, and one that wasn't included in this case, but is one that we can include, is superannuation. So $60,000 a year income, that's great. That maintains your living costs now through to the age of 65. But at 65, what will retirement look like? What kind of planning is there in place? Is that captured in the 60,000? Is it something separate? Is it something maybe beyond the scope of the divorce discussion? In this case, it was deliberately excluded, but it is something to consider. The median house price in the area they were looking at was about $1.4 to $1.5 million. So this puts us at the top end of the budget they wanted to spend. And the kids' school activities over 6 years would cost, they needed about $53,000 in capital to fund that. So to be so blunt as to put a price tag on their achievement of all of their financial goals coming out of the divorce, they needed about $2.39 million of capital, clear capital, to be able to do everything they wanted. I will highlight again that we are financial advisors, us at Planning Solo. We remain deliberately ignorant of the asset pool at this stage. So I don't want to know whether or not this is realistic or viable. I don't want that to colour our calculations or our approach. I simply want to give our clients, here are the 3 tiers, here's how much money you need to achieve what you're talking about. Now let's go back to your lawyer and talk about feasibility and have the discussion and have that reality check, which we'll come to in a moment. The next level is the compromise tier. So this is where we try to pull at a few levers and say, okay, well, with these priorities, which one is maybe less important? Which one do we put first? Which one's critical? And the critical one here, and this is not unusual, was making sure the kids' activities are funded. So that has not changed here, you'll notice. The next one really was that income question. So this particular client was really worried about what they might live on for the next 10 years. There was discussion of they might return to study, they might look at something after the kids finish school in 6 years' time. But until then, they really have no confidence in their ability to earn that $60,000 a year. So what we've done here to compromise is we've brought that back to 10 years rather than 20. So they'll be responsible for that income after 10 years, after the age of 55, which reduces the capitalised amount. We've also dropped the budget on the house. So dropping $300,000, if anybody knows Melbourne, or if you're watching this in the Melbourne area, it takes you from around about Carnegie, a 3-bedroom house in Carnegie, out to a 3-bedroom house in the Oakley area. Not a huge shift, but still a move out from the CBD. So in other words, to achieve what they're looking at here, if they were to walk away with $1.74 million, they could feel reasonably confident that they could tick off all of these objectives. And that confidence is something we're always pursuing in our work. This is what we call sort of the bare minimum, the acceptable, the baseline tier for people when we're preparing this analysis. And it is really stripping out anything we can while still maintaining an outcome for them that is acceptable, that they can be comfortable with moving forward. And in this case, you'll notice we've reduced the income down to 5 years instead of 20 or 10. We've moved from a house to a unit, which has taken 25% off that budget on the house. But the kids' activities, as always, have been maintained. That was the number one priority in this case. So in this case, to achieve these modified objectives, these compromised objectives, this person would require $1.275 million to achieve everything. So what you can see here is we're starting to set out the tiers of money, basically, that if we can get these certain levels, then this translates to that, and this translates to that level of life after the divorce. While it might feel like this can be quite enclosing or frightening, and that it might close off some doors, we actually find it's the opposite. What it does for people generally is it eliminates that uncertainty, and that uncertainty is what corrodes people's emotional state and spirit as they go through a divorce. It's not knowing what's coming up and not knowing exactly what they're pursuing. Talking about a percentage of an asset pool, 45%, 60%, 70%, is fine, but it can rob the scenario of context. Whereas this gives people that explicit context. Okay, 60% is equal to this, that equals to this, so that means that I will be able to do this. So, yeah, while it does feel like it is limiting people's possibilities, by doing that, it actually gives people more confidence, which is a bit of a paradox. This here is just a summary of what we're looking at for people to achieve. So 3 tiers. And the percentages refer to or in relation to the everything level. Very few people will get everything they want out of the divorce negotiation. So what we're saying here is that the compromise level is a 25 to 26% reduction in the overall capital requirement, whereas the acceptable tier is a 45 to 46% reduction in the amount of capital required. So where we picture this sort of working pretty well is during the negotiation process for people and their lawyers. It gives them some not benchmarks, but flags that they know that as they're going through those discussions, percentage equals X dollars equals this. And where this does become interesting, and this is beyond the scope of this video, which I know this is already gone for 12 minutes. This one we're talking about, the next slide we're talking about here is that reality check, which we do not go into at this stage. This is just for illustration. And it's saying that at these tiers, at the different pool sizes, and we've just picked $2, $3, $4, and $5 million as an example here. Here are the percentage allocations that this person will need to receive out of the divorce in order to satisfy these goals. So you can see that the everything tier in a $2 million portfolio pool is simply not a possibility. It just is a mathematical impossibility. But as the pool gets larger, that fixed dollar amount becomes a smaller percentage, which makes complete sense in terms of maths. Just some interesting things in terms of the calculation, though. Sometimes our estimates here can be a lot lower than what people thought they wanted or deserved going into the divorce. So that can be an interesting conversation. But on the whole, because we're based on fixed dollars, it's quite useful for them as they go through it. What's interesting here is, as with most of these sort of tables, this middle section here tends to represent the more likely or the more realistic outcomes for people. And that can smooth out the negotiation process. Now, there's a lot we're not covering here. The components of the pool are very important here. How that money is made up. Tax consequences are a huge consideration that are ignored at our peril, at your peril, as are spousal maintenance considerations rather than a capital injection. So that can be quite useful for people where one party has quite a lot of earning capacity, but they may not necessarily have the assets. Debt is another consideration in here. So this is a very shallow, very basic analysis of really just trying to quantify people's goals. And that's really the first step for us. And this is why we remain deliberately ignorant when we first start talking to people about their goals, about how the pool is made up. We don't want to let that color our analysis at this stage. I'll draw it there. There are details. That's our website. This is not financial advice. It's certainly not legal advice. It is really just trying to explain a little bit about what we do when we're helping people work through their divorce and help them set their own flags and benchmarks and milestones for themselves as they do so. If you have any questions at all, we can be reached through the website or feel free to send me an email. Thanks very much.